Ever wonder how investors make these massive, billion-dollar bets on companies that you can't even find on the stock market? Well, today, we're pulling back the curtain on the single most important financial tool they use to make it all happen.
So, let's start with the big problem, right? For a public company like Apple, you just look at its stock price. Easy. But for a private business, there's no ticker symbol, no 24/7 news cycle telling you what it's worth. So how in the world do you figure out the real price tag?
And that really gets us to the heart of the matter. This is the fundamental valuation challenge. When you can't rely on the stock market, you've got to find another way to measure what a business is actually worth.
And here's the key. You have to ignore all the market hype and public opinion. Instead, you have to dig deep into the company's fundamentals. You know, what the business really produces. At the end of the day, it all comes down to cold, hard cash.
To do that, private equity firms have this incredibly powerful tool. I like to think of it as a financial time machine. It's a way to peer into a company's future and then pull all of that future value back into today. It's called discounted cash flow, or just DCF.
So what exactly is this thing? Well, it's a model where you start by forecasting all the cash a company is going to make in the future. Then, and this is the magic trick, you discount all that future money to figure out what it's worth in your hands right here, right now.
The whole concept is built on one simple but super powerful idea: the time value of money. Think about it. A dollar today can be invested to earn more money, which makes it way more valuable than just the promise of a dollar a year from now. DCF is just the math that calculates that difference.
And you know, for all its power, a DCF model really only has two key ingredients. First, you've got free cash flow. That's just your best guess at the actual cash the company's going to spit out. And second, you have the discount rate, which is basically a number you pick to account for how risky the investment is. The riskier the bet, the higher the rate.
So the whole process is kind of like a three-step recipe. First, you project those cash flows out for, say, the next 5 or 10 years. Second, you pick that all-important discount rate. And third, you just run the calculation to pull all that future cash back to a single number, its value today.
Okay, so that's what a DCF is. But the real question is why? Why is this one specific tool the absolute bedrock of the entire private equity industry? I mean, really think about that. Of all the ways you could possibly value a company, these firms, who are making multi-billion-dollar decisions, have almost universally decided that this is the one. Why is that?
Well, it really just boils down to three main reasons. First, it helps them figure out a company's true intrinsic value, away from all the market noise. Second, it lets them predict their future returns. And third, it is the essential building block for something called a leveraged buyout. Let's dig into each of these.
All right, so let's start with that first big reason: its power to uncover a company's real fundamental value. Okay, intrinsic value. You see, most valuation methods work by comparing one company to its competitors. A DCF, it just ignores all of that. It calculates a company's worth based on one thing and one thing only: its raw, fundamental ability to generate cash. The second reason is that DCF is all about the future. Private equity firms don't buy a company just to let it be. No, they buy it to change it. And the DCF model is where they lay out their entire value creation strategy, projecting how their improvements will boost profits and what their final return on investment will be. This chart here shows you exactly what I'm talking about. They're not buying the company for its cash flow today. They're building a financial story, a model that shows how they're going to transform the business to generate way more cash 5 years down the road. That projection? That's what makes the whole deal work.
And finally, that brings us to the famous leveraged buyout, or LBO. This is where DCF goes from important to absolutely critical. In an LBO, a firm borrows a ton of money to buy the company. The DCF is the only tool that can prove if that company's future cash flow can actually pay back all that debt. And just look at this typical LBO structure. We're talking about 70%, sometimes more, of the entire purchase price being funded with debt. This means if your cash flow projections are off by just a little bit, the whole thing can fall apart. The DCF is what gives them the confidence that the business can actually carry that mountain of debt.
So if there's one thing to take away, it's this. Whether you're trying to find a company's true value, or you're planning a massive turnaround, or you're funding a buyout with billions in debt, it always comes back to the company's fundamental ability to generate cash. So you see, a DCF model is so much more than just a formula on a spreadsheet. For a private equity firm, it's a narrative. It's the strategic story they tell everyone, their investors, the banks, and themselves, about what a company is today and what it's going to become tomorrow.
Which kind of leaves us with a pretty fascinating question to chew on. If the value of a company is really just a well-told story about its future, then how much is a good story really worth?